Hi everyone! So, as promised, today we are diving into China's biggest automaker, BYD. If you haven't watched my Chili deep dive, it's a great warm-up for the comparison. Alright, let's begin. BYD's story starts long before the EV boom. The company was founded in 1995 as a battery maker, then listed in Hong Kong in 2002. And that's where the pivot begins. In 2003, BYD moves into autos, and by 2005, it's already producing its first mass-market model. What makes BYD structurally different is that batteries were never an add-on. Electrification is in the DNA from early on. In 2008, BYD launched the S3DM, often cited as the first mass-produced plug-in hybrid. And in the recent cycle, that commitment becomes explicit. In 2022, BYD stopped making pure IC-only cars. It basically went all in on NEVs. And that long build-up leads to a very visible outcome. Once the product stack and industrial scale were ready, the volume curve stopped being gradual and it turned explosive. On the chart, NEV volumes stay pretty flat, around 0.4 to 0.5 million per year from 2015 to 2020. Then you get the break. 2021 is the inflection point, and by 2024, BYD reaches approximately 4.27 million NEVs. That step change is what this video is trying to explain. With that timeline in mind, let's define the business model, because BYD isn't a pure-play automaker. BYD is a diversified industrial group. At a high level, it spans automobiles with a strong NEV focus, handset components and assembly services, and rechargeable batteries and photovoltaic products, with additional initiatives such as urban rail transit. Historically, the group disclosed three operating segments: rechargeable batteries and PV products, mobile handset components and assembly services, and automobiles and related products. Importantly, the autos perimeter is broad. It includes vehicles and auto-related components, plus after-sales and other related activities. In recent years, the economic center of gravity has clearly shifted toward autos. In 2024, management still describes the group as covering autos, handset assembly, and batteries PV, but the revenue mix is effectively presented through two main pillars: autos versus handset components and assembly. So, the structure for this video is straightforward. Autos drive the cycle, while the handset business remains a meaningful second profit pool. And the battery energy footprint is what makes BYD stack more vertically integrated than most peers. The chart makes the mix shifts very clear. In 2020, BYD generated about 153 billion RMB of revenue, with autos at 82 billion RMB, handset components and assembly at 59 billion RMB, and batteries PV at 11.7 billion RMB. By 2024, revenue reached 777 billion RMB, and the group is clearly auto-led. Autos and related products contributed 611 billion RMB, while handset components and assembly contributed 159.6 billion RMB. and 2025 is extending that trajectory. By January-September 2025, BYD reported 566.3 billion RMB of revenue, plus 12.7% year-on-year, although Q3 alone came in at 195 billion RMB, down approximately 3% year-on-year. With the mix defined, we can move to the economics, margins and reinvestment. EBITDA margin collapses from 14.7% in 2020 to 9.7% in 2021 because BYD got hit by a cost shock, raw materials plus supply chain tightness. While it was ramping hard, more R&D, headcount and operating costs. Then, scale, mix and operating leverage take back control. Margin rebounds to 13.6% in 2023 and 15.3% in 2024. The second pillar is reinvestment, and BYD is in a different league here. The headline is the magnitude. BYD reports roughly 54.2 billion RMB of R&D investment in 2024, framed across batteries, electronics, and new energy vehicles. That's a key difference versus Geely. Geely can lean more on upstream partners for battery sales, while BYD carries more of the technology stack in-house, including battery and broader energy-related products. And the pace continues in 2025. R&D expenses are 43.7 billion RMB for January-September 2025, up approximately 31% year-on-year. So the conclusion is balanced. This level of R&D is a strategic advantage, but it doesn't guarantee share gains every single year. Product timing, pricing, and execution still matter, which is exactly why 2025 is interesting in the Geely comparison. Now that we have looked at margins and reinvestment, the next step is simple. What does that translate into earnings? From 2015 to 2021, EPS is basically flat. BYD is scaling and investing heavily, but profitability doesn't compound yet. A large part of value creation is being reinvested into capacity, batteries, and technology. From 2022 onward, EPS re-rates sharply. By 2023-2024, the move is no longer incremental, it's a step change. For January-September 2025, BYD reports EPS of 2.56 RMB. The key nuance is the share count. In July 2025, BYD completed a bonus plus capitalization issue that mechanically increased total share from 3.04 billion to 9.12 billion, effectively a split-like event. Now, we can check how that earnings step-up shows up in the balance sheet and cash generation. This is a classic build phase, harvest phase shift. From 2015 to 2020, BYD used debt to fund capacity and scale. As earnings and operating cash flow accelerated, the picture flipped. Cash flows leverage fell. By 2023-2024, BYD is clearly net cash, meaning growth is now self-funded with a real buffer. The message is structural. BYD is naturally capex heavy, even more so because it's scaling vehicles and battery capacity. Capex looks normal industrial in 2015-2020, then steps up hard from 2021 as BYD enters hyperscale. That's the price of defending leadership with industrial depth. Working capital is a big part of a cash story. Up to 2019-2020, growth ties up cash. From 2022 onward, it turns strongly negative. Not because inventories or receivables blow out, but because payables grow faster as BYD gains supplier power and extends terms. More of the operating cycle becomes supplier funded, boosting operating cash flow. Free cash flow is the result of two forces pulling in opposite directions. Capex becomes a heavy headwind after 2021, but operating cash strengthens and working capital turns into a major tailwind. So the recent free cash flow improvement is less about capex getting easier and more about scale, plus a stronger cash engine, plus supplier-funded working capital. Return on equity shows a clear before and after. It compresses from 2017 to 2021 in build-out mode. Investment is heavy and equity grows faster than earnings. From 2022 onward, return on equity re-rates sharply, reaching 24-25% in 2023-2024, a very strong level for a capital-intensive manufacturer and fully consistent with the story so far. So the next question is how much of that value starts flowing back to shareholders. The main message here is policy. For most of the decade, dividends were not a priority. BYD kept distributions low and flexible while funding rapid expansion. What changes in 2023-2024 is that payout stabilizes around approximately 30%, which is a reasonable level. BYD is returning some cash to shareholders without compromising its ability to keep investing heavily. At today's price, around 102 Hong Kong dollar, the trailing dividend yield is only approximately 1.5%. The reason is the 2024 distribution structure. The cash dividend was paired with a large bonus stock component that expanded the share base, so the cash dividend per share is lower on the post-distribution base. BYD has done some buybacks, but they have been small and not meaningful capital return lever, so I won't focus on them here. As we discussed earlier, the share count was almost tripled in 2025, so at today's price, the LTM EPS, incorporating H1 and Q3 2025, is closer to 4.2 RMB per share, which implies a PE of roughly 21.7x at the current price. Alright, let's wrap up. What we've seen is a high-quality industrial story. BYD didn't appear with the EV boom, it built the battery stack first, then scaled the auto platform on top, and you can now see the payoff in stronger earnings power, solid cash generation, and a healthy balance sheet. The leadership shows up in the data. In China, BYD isn't just big in NEVs, it's big in autos overall. In 2025, it held about 14.7% of passenger vehicle retail sales and approximately 27.2% of NEV retail sales. On batteries, it's also a heavyweight. In China's 2025 power battery installations, BYD ranks number 2 with roughly 21.6% share behind CATL. The trade-off is valuation. After adjusting for the 2025 share count step change, LTM EPS is about 4.2 RMB, which puts the stock around 21.7x P at today's price. Not cheap for an automaker in a market where pricing pressure can return fast. On the upside, the medium-term setup still looks good. BYD is investing hard in R&D and capex, and its vertical scope, batteries included, is a real strategic asset. Over time, China should consolidate, too many brands, too much capacity, and in a prolonged price war, scale leaders are the most likely to survive and take share. The next frontier is also software and drive assistance, potentially a big value pool, even if competition stays intense. But you still have to respect the cycle. This chart is a reminder the market looks structurally mature. The big shift is ICE NEV more than a big expansion in total units. Think of this as a simple channel stress gauge. Dealer inventory divided by monthly retail sales, basically months of stock sitting at dealers. Higher means more stock versus demand, which usually means more discounting, more pricing pressure, and weaker margins. At 1.31 in December 2025, inventories aren't at a washout trough, so it's not a gift setup, and the high-ish inventory regime tends to keep price wars alive. And that's the bridge to why I'm not a shareholder right now. It's not about BYD's quality, it's about the nature of autos. It's brutally competitive, and it's hard to assign a very high probability to one winner staying dominant 10-20 years out. Autos are also not a defensive sector in inflationary regimes, and as exports becomes more important, trade policy risk rises, especially in a world where more countries are tempted to protect their domestic industries. So my bottom line is simple. BYD looks like an industrial champion, but at approximately 20x earnings in a cyclical, policy-sensitive, price war industry, I personally prefer to watch rather than own right now, even if that means risking to miss the move if the cycle turns sooner than expected. If we do get a cleaner cycle low setup or a more attractive valuation, I'd probably start building a position, because even if I don't love autos as a sector, BYD is strong enough to earn a place in a diversified portfolio. Thanks for watching this deep dive until the end. If you found it useful, feel free to like, subscribe, and share.